All right, so we've got a scenario here where we've got 10-minute convergences and 30-minute convergences in tab 29. And I want to talk a little bit about your exit strategy, or how to build pips in a move. And this is going to challenge you in some ways because you know, what I want to move people towards is consistency in their logic, in their training. You know, I talk a lot about do the math. Well, the other thing is check your logic. You don't want to operate in conflict. In other words, you can't be assuming one thing in one instance and then in another instance do exactly the opposite. You want to maintain the logic flow. So let me kind of push through this, and it'll make a little bit more sense. So I want to talk about two channels today, or two kinds of channels. Now, they don't have to be perfect to the, you know, pip trendline channels. If they are, so much the better. You know, I'd rather see that. But let's just talk about two channels for a second. And one is going to be ranging, but you know, it's got just a little bit of a slope to it, not much. It's a fairly flat channel. And the other one's going to be a steeper channel. Now, the interesting thing in both of these is I'm going to go ahead and draw a multi-wave, and multi-wave is going to look the same for both these channels. So this is a case of, you know, a couple weeks ago I did a little thing about how you approach your sessions. You come and you sit down and you look at your charts, and instead of looking at the 1 minute tab 29 indicator or multi-wave, you want to come into your charts and start with your 4 hour, you know, just get the very big picture, but then get to the 30-minute. Where's the 62? Where are the harmonics? Where's it in terms of harmonics? You know, what's going on with price? Just get a little flavor for it, and then try and see if you see a 30-minute channel by looking at highs and lows in the indicators, and then matching that up on the chart and seeing if you can draw some lines, and then look for a 10-minute channel on the 10-minute chart and see if you can see that 10-minute channel on the 30-minute channel. Sometimes you can, sometimes you can't. Again, we're talking about the path of selectivity. In demo trading, selectivity is very hard to do psychologically because we want to get trades, because we know taking trades is how do we improve ourselves. So there's a little bit of a dichotomy of conflict right there, where, you know, we want to start to learn to be selective. We don't want to learn to program ourselves to take sloppy trades and to try and fight a trade that really isn't a good trade. So just remember, you got to push through that, and live money is all about being selective. So we've got two kinds of moves here, and if I go ahead and populate these two channels with price and just show some movement in price in these channels. Now, you know, sometimes price will come all the way down to a channel in an upward move. Sometimes price will only come down so much and then go back up, etc. Right? And over here, it's the same thing. You know, we've got price going up. It's going to retrace, correct. And then we have price going up, and it's going to retrace and correct, etc. So if I were to look at this, you know, from a scenario down here, let's call this a peak channel. What we're going to have, I'll use green. Let's talk about the 10-minute trade first. So, you know, a 10-minute move here. So let's say these are 1-minute channels. So that's a view on a 1-minute chart. It's just one is steep and the other is somewhat flat. So as we have our convergence and price moves up in this, as I've kind of diagrammed it out here, which I almost always do, I almost always show buys, just that's my bias. So, you know, the 10-minute wave is moving out impulsively, it corrects some, it moves out impulsively, it corrects some, it moves out impulsively, it corrects some, and eventually we have another convergence at the top. Now, to draw the accompanying 1-minute waves on that, I'm going to draw a set, and we're going to keep this theoretical for the moment, and we'll go in and edit it and make it a little bit more real. in one of these cases. But let's just look at this from a theoretical standpoint. So what ends up happening, in order for this 10-minute wave to get to its high, and we know it's finished with the impulsive move up and now it's ready for its correction, well, the 1-minute wave will be at the top. And then we'll know this wave has corrected and finished the correction when the 1-minute wave is at the bottom. Now, something important to notice, even in the waves here, when I look at the difference between the 1-minute and the 10-minute wave, notice that the 10-minute wave has an impulsive move and a correction. And if we look at that from a price standpoint, what that means is there was a big move here and a tiny move here. And that's typically what you're going to see with an impulsive move and its correction, right? So what ends up happening then is, let's finish out this plot and then we can talk some more. So we're going to go up to another high, and then we're going to come down to another low, and then we're going to go up to another high, and then maybe this doesn't come all the way down. Let's just say that for a second, and then it goes back up. Okay? So that's somewhat of a textbook look of this tab29 indicator with a 10-minute convergence at one end. Now, essentially, though, this is the same multi-wave for both these charts. When I get to a top here, I'm at a top in my channel here, and I'm at a top in my channel here. When I come to a bottom, I'm at the bottom of my channel here, and I'm at the bottom of my channel here. Multi-wave, despite this being so steep, multi-wave has a unique way of kind of flattening that channel out so it can be presented down here. But both this semi-flat, ranging kind of move, as well as the steep trending move, both of these are going to look like this down here for the most part. Which is why you don't want to start down here. You want to start up in the price field. And specifically, better off with the larger time frames first, and then work your way back to the 1-minute chart, and then work my way down to my indicators. Don't start here, because this is a relative indicator, and it's accurate in what it does. It tells you the top of the channels and the bottoms, but it cannot tell you distance. It cannot tell you the angle of the trend. And so because this is the same look, we have to understand what's going on up here, because if we really want to optimize our profit, we're going to have to trade this same indicator with this same look differently for one of these, for each one of these moves. So they're not equal. They're going to look the same in the indicator, but I can't treat each one of these the same when I look at the indicator. So let's look at the reason for that. And the reason for that, I've been big on the math lately. Now we get into geometry. And that goes back to your, high school days when everybody said, well, when will I ever use geometry? Well, here's a case where you will. If you think of a normal move, if you think of me talking about Elliott wave, we'll go down to the right-hand corner for a second, and we talk about, let's say a 1, 2, 3 move. So we move up to our 1. We have a very quick and deep move for our 2. That's typical. We know that 2 move likes to pull out of there somewhere between 50 and 61.8 of the 1 move. 73% of the time, that's where it turns around, and then it moves up impulsively to the 3 move. And we don't want to forget those kinds of numbers in thinking when we have to look at this move and we have to look at this move. What's the reality down here in the bottom right-hand corner? How can this thing pull back at 61.8? If you'll notice, it can, because we're just isolating this as an open move. We're not putting this in any channel. We're not showing else what's going on in the channel. And so, we take our Fibonacci tool and we stretch it across this, and we look for that 50, and we look for the 61.8, and this thing should turn around somewhere in there, right? We know it could be lower. We know it could be higher, but again, 73% of the time in that space. So we have some valid data But that's, again, that's kind of textbook, because that's assuming this is kind of a flat move. You know, the channel that this is in is kind of flat. Notice over here, as I've drawn this as a flat channel, if you look at move 2 as a function of move 1, i.e. it's a corrective move, notice how deep that retracement is. Because again, we kind of put everything flat when we do that. And so we look at this move up and we look at the percentage down, because this move up, regardless of the angle, that's how we measure it in verticality, straight up. And then we look at the retracement back against that. And you'll notice how deep that move is. Right? So here's a 88.6% retracement. And it actually hits the bottom of the channel. 100% would be down here, right? Out of the channel. But it pulls back 88.6. So we have another move up. We have our third move. It's up. And it pulls back. And notice here, you know, maybe 50% of the move up. All right? So free form, free open space, you can have these kinds of pullbacks. Now, keep that in mind. Got it. I'm going to clean up my diagram because Tuesday, I'm just a bit OCD today. All right. So we want to then be careful in how we would track that kind of move versus the one on the right. So let's understand the one on the right, and then we'll talk about how we money manage these and how we make success out of our trades with these. All right, my OCD is complete. So now over here, notice the steep angle. And from a, you know, previous training perspective, we know a couple things. We know these are the harmonic wave convergences at the top. And they're hard to catch in a steep move because this likes to slide. And this price likes to get up here and just push and push and push, and then it finally converges, and then it'll retrace, right? So these are hard to catch, which is why if you have a steep move, you know, from bronze onward, I said don't try and take those harmonic wave convergences. You want to take them, but you only want to take them when you have pips in hand. And you do that both for a practical standpoint and for a psychological standpoint. If I have pips in hand at this point, then if this slides a little and I go -3, that's okay. And the reason I want to take this trade is why? Because it is harmonic wave convergence. It is the end of a run temporarily, and this very well may be the channel breaker. This may be the one that just takes off and goes 144 pips. So, you know, I say these are emergency entries. We know our real profit's going to be driven by these impulsive moves that have just, you know, this is like a gas balloon. It's going to go up, and if this is a A-frame house, it's going to go up to the highest point in that A-frame. You know, and the reason it bounces a little here is because it pushes, trying to go higher. Maybe static finally holds it still, right? So this is a balloon. You notice price doesn't go backwards. Price doesn't go this way, right? Price can only go up and to the right. So even just based on this angle here, I could come in and draw a vertical line from my pullback, the end of my pullback, the correction of my pullback. I could draw a vertical line, and I know pretty reasonably well price is not going to go to the right side of that. I mean, to the left side of that. It has to go to the right. The only way it could go straight up that line is one big blue candle. But even so, you look at the distance that you're gaining. It has nothing to do with the width of the channel. As you measure the channels, you know, from top to bottom, this is verticality in this direction. But that's the width of the channel only in your buy. It's not the width of the channel in your sell. Okay? Because remember, what's going on in here is there's massive push pressure upwards, which is why you have the channel steep to begin with. So there's massive pressure upwards. So when this move gets to the convergence, it's hard to pull back. The pressure holds it up so. And if you draw a normal move where I have a move up and it retraces back like that, in this case, that retracement is going to be hindered or stopped by my trend line. So notice we're maybe at 38% here. We can't even get to 50% of the move. Nonetheless, 61.8, unless we've done the channel break. So these retracements, even though they may look the same down here, are much shallower than they are over here in the ranging market. Over here, as we said, this could be, this if it pulls back all the way to the bottom of the channel, look at that, 88.6% retracement. Look at it over here. You know, what's that? 23.6. Which is why these steep moves are great. Now let me show you the reality of trading this, if that's the world. Because again, we have this indicator at the bottom, and we can't treat it the same way all the time. It's specific to the situation we're in. This is just real world, guys. I mean, you know, that's why you can't have true black box systems. That's why robots never work. Okay, well, very rarely. Because somewhere in there, they're making decisions based on some indicator value as part of their formula. And the problem is, as I've just shown, this indicator can serve two different looks in the price chart, which we really should deal individually. Okay, deal with them individually. So let's look at this for a second. In this, let's look at the move on the right first. So if we have a normal move as a trader, what we typically do, if this takes off on us, and let's say this channel was essentially about 10 pips from top to bottom, as I would measure it that way in the diagonal of the channel. In other words, if I drew a stick figure 10 pips and pulled it over here and turned it sideways, let's just say that channel's about 10 pips wide. Now remember, the channel isn't 10 pips wide in terms of the channel all the time. We can only call a channel with one width if it's somewhat flat, because the distance up is pretty much the same as the distance down in verticality. That's not true here. If this is 10 pips like this, this channel may be, as you can see, almost twice that width. It could be 20 pips up. And it might only be 5 pips back. 23, 25% retracement. So we can't say, oh, that's a 10 pip wide channel, because going up, the impulsive moves are going to be much bigger than the corrective moves. But the nice thing about this is then money management. So we started out talking about this being a 10-minute convergence down here on the bottom left-hand side of the chart. Now, what do we normally do when we think of this as a 10-minute convergence? What we normally think of as our target over here, convergence at the opposite end. Now that's, you know, it's an assumption, it's an expectation. We have to deal with things if that's not what happens. So if we vary from the theoretical and the conceptual and it doesn't manifest itself as reality, we just don't, oh, well, I thought it was going to converge. No. We don't want to do that thinking. We want to see, oh, I'm here. What am I doing for money management? When I'm here, what am I doing for money management? When I'm here, what am I doing for money management? Turn that off. All right. So it's, remember, a real-time system. So we want to keep our mind tuned to that. It's okay at the beginning to have an expectation based on what you see on the charts. You have to have something to trade to begin with. You have to have something that guides you from the begin with. We're not going to sit here and trade, go, oh, I have a convergence. What's your strategy? I'm going to go with the flow and see what happens. No, that's, you're inviting ego and emotion to participate in the trade. So you do have to have some sort of initial expectation. But don't let your ego get married to that. That expectation is based on what the chart is telling you. And at this point down here, the chart is telling me I have a convergence, and therefore my expectation is this thing's going to go to another convergence at the opposite end. So that's how I have to start out trading here. That's it. If it changes along the way, we have to change our approach. But right now, that would be our expectation here as we enter this trade. Now, if we're talking about this particular multi-wave representing this particular channel, the concept of going from convergence to convergence makes sense in terms of this 10-minute wave. Realize the 1-minute wave is going to have a top and a bottom, a top and a bottom, a top and a bottom, and that's what we see right here, the 1-minute wave. This is a 1-minute chart. So we see a top and a bottom, a top and a bottom. And the whole while, what's going on in there, if we were to really kind of grab, you know, a layer, if you would, and think of 10-minute price in that channel, it's not going up and down. It's starting down here and essentially winding its way up to wherever the convergence is going to be up here. And that's why it looks like this down below. The 1-minute wave is cycling to take that wave up. Remember in my Elliott wave, I always talk about, oh, we've got that big 2 to 3 move. And inside that 2 to 3 move, we're going to have a substructure. 1, 2, 3, 4, 5. That's exactly the kind of scenario we have going on here. When it's steep like that, it looks just like that. We have our shorter term or our sub-level wave cycling from its tops and bottoms while the 10-minute wave goes up there. That's the representation we got here. That's the representation we really have there. So how do you trade that? It's pretty simple. If you're in a move, let's say a 10-minute move, and you get up in magic pip land. In other words, we know a 10-minute move by how many times I've drawn this matrix. You know, a small 10-minute move can be 5 to 7 pips. A medium-sized 10-minute move, 8 to 11 pips. A big 10-minute move, 12 to 15 pips. And we have to acknowledge, you know, that's bell curve, so there's stuff on this side of that bell curve. And there's stuff on this side of the bell curve, but that's the general stuff. So if I enter a convergence here, and I get up and I'm 20 pips up here, obviously I'm already in a big size move. So to protect myself, what are we typically going to do? We're typically going to put our stop loss at 50% of that move. Let's look at over here on the left. So we go back to our flat, somewhat ranging, but it's got a little bit of a trend angle to it. If we have this kind of a move up here to this point, we put our stop loss at 50%. And that's to say, we'll give this a little room to come down in case it wants to go higher, but if it comes below that, we're taking ourselves out of the trade. And that's what we do. And there's plenty of times when the market's somewhat flat or you have an isolated move where we get taken out at 50% because there's just no better way of handling it. Over here, we can't be taken out at 50% because here's our 50% line. The channel prevents price from coming back down. And indeed, not only does the angle of this channel contribute to that, but the width of the channel. So the smaller this channel is, the better. The tighter this channel is, the more it prevents this pullback from going deep. If that channel is shaped like that, you're just not going to see a pullback that does this. There's too much upward pressure. It can't do it. It's like taking a freshly filled helium balloon and letting it go. You don't see it sink. You could put your hand on top of it and try and push it down. But, you know, unless your hand's perfectly balanced on the top of it, it's going to try and find its way around you because, there's just such upward pressure. So price isn't going to do this in this kind of steep channel. And again, the farther inside this trend line is, the less that pullback can be. It's got a wall. It can't keep pulling back. So it's going to stop. So for life being easy, and why I talk about why I love these steep moves so much, is our money management. As we look at this convergence down here, again, bottom left of tab 29, our goal is to get to the convergence to the other side, which means when we enter the trade down here, we don't need any stop losses. The only stop loss we really need can essentially be another trend line just outside of our first one. That is our channel breaker. Now, this is why you need precise trend lines. This doesn't work if you have, oh, that's close. This doesn't work if you don't have 2 good points before you really start getting involved in the moves inside the trend line. So if I got a trend line that's stopping things to a candle wick, then I've got something I can trust. And therefore, this line, I can have 1 to 2 pips outside of my trend line, and that becomes my MSL. Well, I set an MSL down here at 50%. I'm never going to get to it without the break, which means from the time I enter this trade, I never exit until I get to convergence at the other side. My exit in this trade is up here. When price gets to a point that the 10-minute wave is at its extreme, somewhere up here. So I enter the trade down here, and price goes up. Now, for those with European brokers or Australian brokers and with sufficient leverage, these are places you can create what I call stack trades. And that means I enter this first trade down here. I have no reason to exit it other than if it breaks my trend line. That should come from a harmonic wave convergence. And I should be in that trade. So the trend line break isn't going to scare me any. And as price moves up to here, I stay in the trade. Don't make the mistake of exiting here on this trade that's a 10-minute convergence, and this is continuing to look steep. Let that balloon rise all the way to the top. I don't need a 50% stop loss. You can draw it, but it's wasted time. I'm going to stay in that trade. And more importantly, I can't take myself out at these tops. Why? That'd be ridiculous. Let's talk about maximizing profit. Let that trade run. But what I can do is enter another trade here. And again, as that trade moves and it goes up, I don't need a 50% trailing stop loss. I've got my channel breaker stop loss here. And so trade 2 can go up and float. It's adding another balloon to the mix. And if this thing, you're far enough and this thing is sustaining itself enough, you might even have a chance for a third entry. It's supposed to be white. So these are called stack trades because you can just stack one. As long as you got the leverage and you have the margin available because the leverage affords it, you can stack these trades. And so by the time you get up here, as I've illustrated before, this could be a 60 pip move total, all the way up. And this second one, well, guess what? It went for 45 pips. And this third one, it goes for 30 pips. And maybe a fourth one goes for 15 pips. So you end up making 45, 45, 90, 60, 150 pips on a 60 pip move. That's why these are fun trades. And when it breaks the channel, it breaks the channel. You didn't make any stupid indecision. You didn't make a bad decision. The channel breaker is the channel breaker. All channels are broken at some point. So this particular look of tab 29 with these the peak 1 and the peak 10, I decide at convergence to ride this all the way to the top. The pullbacks are so nominal, it makes no sense to do anything except stay in that trade. Now let's bring our attention to the ranging, somewhat flat trend that we have on the left side of the page. Remember, as I said earlier, the challenge with these are nothing stops the retracement. I don't have the benefit of the angle that I have over here on the steep trend on the right. So there might be some angle, it might be flat, but let's say it's pointing up. So my strong move is still going to be the convergence. But now let's look at this. If I have a 50% stop loss, what's going to happen in this move? I go up, well, if I keep the numbers the same as I had over there, I go up 20 pips. I have to protect myself with the stop loss. So if it's going to come out and actually stop me out, I'm going to get stopped out at 10 pips. Now, again, we don't want to beat up 10 pips because 5 pips a day is all we need, right? So 10 pips we want to celebrate, but at the same time, we don't want to be like so casual that we just don't care about the other 10 pips that we just gave away. And if we do get exited out there, how are we ever going to get to this point over here? Well, what will probably happen is this will look like some sort of retrace extreme, and maybe it'll look like this, and maybe we have a 1-minute buy opportunity. Who knows? But it's hard to get from convergence to convergence when it's somewhat flat. Kind of makes sense. The higher high it's a struggle to get there because there's big pullbacks, slight gains. So same indicator look down here, but our strategy has to change because of the reality of this channel. The reality of these pullbacks can be steeper. And 50% is going to give us that too much erosion in this trade. So again, top right in the steep channel, we entered down here and we just stayed with it because none of these pullbacks are significant enough. And in fact, we entered stack trades at these spots to add to this. And so when we finished a 60 pip move this way, we actually made 150 pips because we stacked our trades inside that. Let those balloons, just kept letting loose another balloon every time it hits the bottom wall or the floor, however you want to reference it. Over here on the left, again, we don't have the wall blocking us, so we can have these deep retraces. And who wants to go up 20 pips only to watch 18 of it erode on the way back down, to 88.6? That's stupid. So our strategy for trading this below has to change. Well, it doesn't have to, but if you're a trader, you're going to want to change it. Okay. You want to play this smart. So what you're going to do here in this situation based on price movement, again, this look serves two moves. It serves the steep trend and it serves the very flat trend. And it'll serve everything in between. It's going to look exactly the same down here. So here's what I'm going to do in managing this trade. Now, I'm going to enter at my harmonic wave convergence, and I'm going to exit at the end of that impulsive move, which is, in this case, the 1-minute wave at the top. Because I don't want any bleed off. Now, if my assumption is this trade is going to go from the convergence to a convergence at the upper right-hand side, have to understand that I'm going to have a cycling of the waves. It has to cycle. And there's two sides to the cycle, as we talked early on. We have the impulsive side of the move, and we have the corrective side of the move. We have the impulsive side of the move, and we have the corrective side of the move. The impulsive side typically is bigger than the corrective side, which is why, you know, you don't have 100% retracements all the time. Move up, 38% retracement. Move up, 50% retracement. Move up, 61.8% retracement. So the bigger pips in each one of those moves is the impulsive move up, not the corrective move back. That doesn't mean there can't be pips there, depending on the height of that first move up. But remember, if we get a 38% retracement, it's only 40% of that move up. So if I have a 10 pip move up, it's only going to pull back 4 pips at a 38% retracement. So what I'm going to do is enter here at convergence and ride that impulsive move up. Boom. Now I put those 20 pips in my bank instead of letting them erode off. I have options here, but let me discuss option 1. And that is, if I've determined this is a convergence and I set my target up here and I realize there's going to be some cycling, and guess what? You can see it on this first wave. As the 10-minute wave moves out and the 1-minute wave pulls it up, you can see the cycling. It makes no sense to stay in that trade. Even if price doesn't pull all the way back down. Let's say like this one here. This is the convergence, let's say. Price moves up and it comes down here and goes back up. Well, what happens in that move? If this is 20 pips up, you just pulled back. Let's say you don't have a stop loss on it here. No 50% at this point. So you go up 20 pips, it comes back 10, and now it's got to remake those 10 again to get you back up essentially to 20 pips. Now it might go up 11 just to provide a little slope. But nonetheless, you know, when you get here, what's the difference between the profit here and right here? Maybe a pip, maybe half a pip. So you had all this work going against you, and you had to hope this was going to continue up to get back to where you already were here. So in this strategy, option 1 says, I'm going to ride this impulsive move. I'm not taking the corrective trade. When it comes and corrects down and gets to a bottom, I will re-enter again. And I will ride that to the top, for which I will exit again. So I'm just going to do these move after move after move until I get to my convergence. Now, if you look at it from a price standpoint, if I redraw this graph to be favorable to you as a trader, instead of keeping it theoretical, let me redraw this to be favorable to you as a trader. I'm just going to have to do a major redraw here, but that's okay. Just bear with me. And what do I mean by favorable to you as a retrader? Let's say it never challenges your stop loss. Let's say you set your stop loss at 50%. And these retracements, you know, they just kind of came in here at, you know, there you are at 47, whatever, goes back up, you know, cycles down a little bit, 38%, goes up, comes back a little deeper on this one, goes up, and let's say, you know, we have a new convergence point. Well, you're doing the same work just too many times here. And now you'll see the idea of what we're talking about with exit and re-enter. See, if I enter here on the bottom left at convergence point, and I go up, and let's say that goes up 20 pips, and it pulls back 7 or 8 pips. I'm still in the trade. It goes back up here. Well, wow, now I'm at 22, 23 pips. But it pulls back 7 or 8 pips. Have to re-earn those 7 or 8 pips, and maybe it makes another pip or 2 more. Climbing just a little bit. Another 7 or 8 pip pullback. It's got to make another 7 or 8 or 9 pips to get up here to convergence. And so let's say it gets up here, and finally, you know, here we are, 28 pips. So we got to 20, we pulled back to 13. From 13, we went up, gained 10 to 23. We pulled back 8, oh, we gained 7 to 25. You know, we pulled back 8 or 9, oh, we gained, you know, 9, and we got up to 28. So the total for this trade from entry to exit is 28 pips. But what if we entered here and we exited here? There's 20. And we got in down at the bottom here. And we go from 7 to 23. Or, 13 to 23. Pulled back 7. 13 to 23. And we exit. That's 10 pips. And then we get in here, you know, let's say this pulled back 7 pips. We're at 16 to 25. And then we made 9 pips there. And it pulls back again. Let's say, you know, 10 pips. We're down to 15. 15 to 28 is 13 pips. 30, 39, 49, 52 pips. In the same trade, in the same move, which would you rather have? 28 or 52? Now here's the fear in exiting at these tops. Your fear as a trader is, well, what if I can't get back into this trade? Your ego and your emotion subconscious is going to try and plant that scare in you. And I say, well, that's okay. On the other hand, what if it gets down here and finally crashes through your stop loss and takes you out, and you only make 10 pips out of the trade? Here at least I made 20. Even if I can't ever get in the trade again, here at least I made 20. If I can't get in the trade again because this trade ends up, you know, going negative, going south on us, I made 20, you made 10. This is what I was talking about trading in conflict. If the assumption is I'm going from one extreme to the other extreme, then trade that logically to maximize your pips. And in a flat channel, that does not mean staying in the trade. That means I'm going to exit here. So every convergence at the 10-minute level that goes to another convergence at a higher level, I'd say 50% of those trades you should have 2 or 3 trades in. You should have a buy going to its impulsive end. You don't play around with the correction and then go the other way. Now the only time I'm going to end here and actually enter a sell is if this is a very flat channel and this distance really is pretty big. You know, we are talking that 20 to 25 pip channel. Not a 10 or 15 pip channel, but much bigger than that. Because there will be some pips you can have here, and you ride this down, and you don't try to be the big pip hero here. Anything that looks like it's close to the end of a retracement, which means anywhere close to my peak 3 turning around, it doesn't even have to be an extreme, just turning around mid-channel. If it looks like it's the end of the retracement here, I can exit that sell. Those are gravy pips. But then I want to get in the buy, and I want to get in the buy. So again, the significance here is I have one look for tab 29 indicator. It could be and should be traded differently depending on the circumstances with my price. If price is flat or I can't determine the trend, then I think if you can see an impulsive move, you want to ride that impulsive move until its end. Don't make the mistake. Now the problem with this is I see people taking a 10-minute trade and they get in here and they do exit here, but they're exiting only because they're freaking out, only because the 1-minute wave is at extreme. They're not understanding that's the end of the impulsive cycle. There's going to be a corrective cycle. I should have another impulsive cycle. I need to have impulsive cycles to move this wave up. And those impulsive cycles are the big game. And they exit their 10-minute trade. I entered a 10-minute trade and I exit. Why'd you exit? Oh, the 1-minute wave got to an extreme. It's not a reason to exit a 10-minute trade. Unless I entered a 10-minute trade, I was going to ride the impulsive side up. It was flat enough that I didn't want to use a 50% retracement. I wanted to maximize my pips in that impulsive move. I rode it to the impulsive move ended, and I'm looking to get back in this at another buy opportunity. It either happens or it doesn't. See, if it happens, you just get back into it. If it doesn't happen, well, guess what? You made 20, whereas the other guy would have made 10 because he stayed in there with a stop loss. On the right, with the steep move, same look in multi-wave, same look in tab 29, excuse me. I could enter at the convergence and just stay in that trade. My MSL becomes a trend line outside the trend line. So how price looks is going to depend on what strategy I use with the looks that I get inside tab 29. I can't just come in and trade tab 29. It serves two masters. It serves many masters. But as I've drawn it out here, it's serving two masters, a flat channel and a steep trending channel. So you can't just come in and put a cookie cutter and trade tab 29 the same all the time. It's situation specific. Don't make it rocket science. It's not complex. Remember what tab 29 is showing you. Just like multi-wave, it's showing you tops and bottoms. It's lighting the path for pips, guys. So in a super, I used to call these hyper-extended moves. They just kind of have verticality and they just keep going up and up and up, and they're within a tight channel. Those are pip makers because I can stack trades. I get in a trade once and I let it run. I don't need to have a 50% stop loss. The channel will be the stop loss. And I can add additional trades to it every time it comes close to or bounces to the bottom. Taking this to the master's degree level or taking this to an advanced level, you may have a channel where it doesn't make it to the bottom. Why would that happen? Because that pressure, as I said, is so strong. You just got huge pressure upwards. So I might have a move up and it comes down like that, and then it goes back up higher again, and then it comes down short and it goes up again. Well, what's that look like down in multi-wave? Or, excuse me, tab 29. That's going to be those scenarios where you get to use trend lines in your indicator. Oh, it's a funny looking tab 29 indicator. This is going to be one of those scenarios where the 1-minute wave, as it's pulling back, so it goes to the top, it doesn't have the strength to come all the way down. Why? Because there's upward pressure. Goes back up to the top again. Comes down. As this thing moves up, these can get shorter. Doesn't have the strength to come all the way down again. It can't come down because there's too much pressure pushing up against it. I got a fan down here and I got a balloon. Even if that balloon is, blown up 2 or 3 days ago and it's just kind of floating without rising or anything, and it starts to sink, that fan has enough energy to push that balloon up. It just can't come down farther when there's huge upward pressure. Well, guess what? This is now when I can have a trend line in my channel, and I can take advantage of that and start trading these bottoms that don't come to a bottom. So I can still trade that impulsive move up. That's when we get to use trend lines down here. And there's even a more advanced play with this, but I'm not going to go that far in this video. So these multiple buys, these stacked opportunities, all stem from the steepness, the fact that I can't have a retracement that comes back deep enough to take me out at 50%, so I can just enter this trade and let it float up. And as I pointed out in the tab 29 trading and these kinds of moves, when I get in this second trade and it starts its way up, if I were to use a stop loss on that second trade, you know, as it's moving from 2 up to the top, you know, here's my 50% stop loss. But guess what? That's now also the stop loss for my one move. And why I don't have to worry about it is because up here at 2, at the top up here, I'm not going to have a pullback that is that deep. Again, the exit point will be the channel breaker. So when something finally crosses through my trend line, then I'm exiting all my positions. But I can just keep adding position every time it gets to the bottom, or every time I have some sort of short pullback that I have some other reason to take. These are your profit makers, guys. This is how you make 150 pips in a 60 pip move. This is how you make 45 pips in a 28 pip move. Is by stacking these trades, getting in this one and letting it run to convergence. Let multi-wave down here, let tab 29 here and tell you the story. Watch it cycle up as it's doing this almost vertical run. And you see the 10-minute wave being lifted. Every time the one gets to a top, the 10-minute wave lifts. A very shallow retracement of the 10-minute wave. Because why? It's pulling back just a few pips here in the channel. And then it takes off again. So you have this impulsive move driving it up until we finally get to the convergence. And just in case that's going to snake on you, you don't even exit at the convergence. You wait for price to come back and go through your channel stopper. Your stop loss set at your channel break. Over here, if I'm assuming I've got a convergence and it's going to go to the opposite extreme, I might as well just take myself out because these pullbacks are killers. Don't sit here and think, oh, I might not be able to get back in this trade. Because if you think you're not going to get back in, you're trading in conflict. If you think you're not going to get back in, you're fearful of this thing going the other way on you. Well, if it does, you've wrote it off a good portion of your profit. In most cases, 50%. So I enter, I exit at the end of the impulsive move. Now, you keep hearing me say impulsive corrective. You have to understand what that is. You have to see it in the charts. It's my expectation leaving a convergence. The only other scenario that can occur down here is where the 10-minute wave converges, but lo and behold, there's a 30-minute convergence at the same time. Well, now the 10-minute wave may not be going to an extreme. It may be cycling, just as if it was going to an extreme, but it's actually retracing to the end of the 30-minute retrace. And then it's going to go back down and converge. Well, think about the strategy there. Same thing. It's going to move out impulsively. If I exit there, one of two things is going to happen. This is either going to come back down and converge down here, or it's going to just pull back and then continue up. So by exiting up here, it makes more sense if I've got a snake down here. Everybody's trying to do this sell into the buy. But again, remember, this very well may be an impulsive move out of here. So catch that impulsive move. Up here, you can exit. If you want to enter the sell into the buy, go ahead. But you're not bleeding off your buy at that point. If this goes back and converges, wow, you're in luck. But it very well may just, as soon as your 1 minute wave turns around, I don't care where it turns around, you need to be out of that trade because that's the corrective side of the trade. So it's how you can prevent the, I don't know whether this is cycling up to a convergence or if this is just going to be a retrace. You take that away by this strategy, by maximizing your pips on the impulsive side and then not taking the corrective side. The only time it's going to be the corrective side at the top, the only time it's going to be the impulsive side at the corrective side, the only time it's going to be an impulsive wave where it's normally the corrective wave is when the 30-minute retrace is finished and now we're going to race back to a convergence. So the retrace is ending. And that's why if you enter these sells into the buys, but with the rationale of I'm going to exit on a peak 3 hookback. Those would be exits because now it's saying, oh no, it's not going down converging. It's just actually cycling like I originally thought. So I exit that trade and hopefully I have a mechanism to enter the buy. These are great when this 1 minute wave comes down and converges into the 30, but the 10 doesn't. That tells you there's, it's not a retrace end and it's going to cycle back up. So guess what I do? I enter my peak 3 again. At that point, it's not a 30-minute trade, even though the 1 minute wave is hitting the 30. That's not a 30-minute trade. This is my 10-minute trade impulsive side because the 10-minute trade is continuing up. But this is the buy, get out at the top, buy, get out at the top, buy, get out of the top. When I finally find the top one that comes down and goes to reconvergence, if I've been entering the sells and the buys, I'll catch that trade. If I enter my sell into the buy after I've exited this, then whenever my 1 minute wave turns around, whether it's short, medium, or all the way down at a extreme converging into the 30, I'll exit those sells into the buys at that point. And I should be ready to get right back into a buy, in this case, another buy into the sell. So the whole point of this teaching is to realize that in the end, we don't want to come into our charts and go to tab 29 and try and read tab 29 to get a sense for what's going on. We want to figure out what's going on in the charts and then realize how we can apply what we see in tab 29. Because this reality versus this reality tells us we need to trade differently. This one we're going to stay in. This one we're going to exit after the impulsive move. You have the option here of entering, in this case, the downward move, the corrective side. Here, don't bother with the convergences as your primary move. Take them as emergency trades. But I want a -3 here. I want to be wrong here. Why? Because it's going to be 20 pips up. But if I happen to catch a convergence and it is the channel breaker, well, again, guess what happens to my buy? I get stopped out on the trend line, but my convergence goes down 80, 90, 100 pips. So I win-win. But I don't want to see a steep move and try and capture this as my first move, like the bronze traders were trying to do, at the start. They didn't know about buys and the sells, so it's okay. They were doing what they were taught at the time. But it's also why I said don't evaluate the system. You're only seeing a piece of it. So now we know I want to take that harmonic wave convergence because it may be the channel breaker, but I only want to take it once I have pips in hand. Or I got a real strong head game. Because almost always that's going to go negative until it is the channel breaker. All right. So again, the summary, don't just try and trade tab 29 indicators. You may have the exact same look for two totally different situations, And your money management has to be driven by the situation, not by tab 29. We just use tab 29 to facilitate it, to show us when and where to apply the details of our money management. And so, well, what happens if it's not flat and it's not steep? Well, by what I've said, what do you think? If it's not steep enough, I can't enter a trade and just let it run. I can't enter a 10-minute convergence and just let it run, because at some point I'm going to give up 50% of my income, 50% of my earnings. So I still am better off trading the impulsive side and trying to get back into a buy into the sell, back into that impulsive side, and then flip all this upside down for sells. All right, so I hope that brings some clarity. Hopefully I didn't confuse anybody, but this is important to understand, because I got a lot of traders that are trading based on what they see in tab 29, and that's not going to work, because which situation are we really applying it to? That's what you need to know. And you know what? If you don't know what the situation is, guess what? That's called selectivity. In live trading, those are times you don't trade. And that's why I've said, and again, I don't mean to sound arrogant, because I'm not trying to be, I only take trades I'm going to win. Why challenge your mental game by taking trades that are iffy? There's only one time to enter a trade that is iffy, and that is in that iffiness, it's 50-50, and you have tremendous reward to risk. But if I can't see channels and I really don't know what the reward to risk is, it might be 1-to-1. It might be 2-to-1. It's not worth my time. If I can't figure it out, it's not worth my time. So the way you avoid iffiness, the way you avoid -3s, is to just avoid them. Don't take them. Take the trades that there's plenty of trades that work just fine. And as you continue to trade tab 29, you're going to see more and more and more of them. And these things that a lot of people call scalping are really just a 1-minute wave that is a piece of a 10-minute wave. It's the impulsive side of a 10-minute wave. What happens when I can't tell what the 10-minute wave is doing? Yeah, I had a trader yesterday that had a, I'm going to erase this now. You can always go back and pause it. But I had a trader yesterday, had a trade, and literally, this is what we saw in multi-wave. I can't tell which is the impulsive side and which is the corrective side. So it's a total game if I'm going to try and take, sells and buys based on 1-minute trades. That is scalping. And it's pot luck what I'm going to get. I guess I can enter, and as soon as I get some sort of pullback on the green, I'm out of the trade. But that's just, it's like, why? Don't take trades just to, because you've allocated some time and you got to get a trade in. I know traders' mindsets, they sit down, I got 2 hours tonight. I had a long day at work, and, I really, really, really have to dig deep to sit down and do the charts, because I'd really like to grab a 6-pack and sit out back, or, watch a TV or whatever. So sometimes it really, you have to dig deep. I got to stay committed, I'm committed to this. And you sit down 2 hours, you don't have a trade, because nothing right comes along. The selective trades aren't there. And then you say, man, I just wasted 2 hours. No, you didn't. You just spent 2 hours proving that you have the discipline to look for selective trades. It's not about, oh, the market didn't give me anything, oh, the market's crap right now, and you have a negative attitude. Flip it around. Man, I want to congratulate myself. I didn't occupy my time and feel the necessity to take a trade just for taking a trade's sake, because, I declared it's time for me to have a trade. See it on the positive side. I had the discipline not to take crappy trades. Because if you establish that as your habit now, it'll stay with you when you go live. Now, again, you have to learn at some point, so I understand that there's a threshold, and I don't know where to put the thin line on where we're going to define that between a trader that has learned enough that they can be selective and a trader that is still kind of exploring and using their trading account as their laboratory. You know, that's okay as long as you segregate the mental game from that. But when traders evaluate, oh, I had a terrible week, you know, and I start looking at the trades, well, why'd you take that trade? Why'd you take that trade? You know, you can tell when people are desperate for trades. It shows up in their trading. It shows up in their logic. They can see it afterwards. I didn't belong in this trade. So why'd you take it? Subconscious took over. Subconscious says, oh, I'm spending all this time. I better get a trade in. Oh my gosh, I got to, you know, the private coach students have the extra burden, if you will. They get extra benefit from, you know, having coaching, but they get extra burden because they have a pressure to perform. They have a pressure to come to the next session with me and have trades. But I've said it before, I'd rather have a trade posted that is a no trade. Hey, I sat down, this came along, let me show you what I saw. This is why I didn't take that trade. No, I don't mean to do that. You know, we had a run of people just submitting no trades all over the place. You hardly see them anymore. Why? Because with tab 29, you see more trade opportunities. So remember, come to the charts. Big picture, drive it down 10-1. Big picture, look for channels. Can I see some trend lines? Let me just play. That's how you use your charts as your play station, as your laboratory. Try and draw some trend lines. Try and draw some pitchforks. You'll be surprised how many times stuff surfaces that you didn't see right off the bat, but you start putting pen to paper, drawing pitchforks and drawing trend lines, and things will take shape. As I've said before, look at multi-wave. If I'm on a 1 minute chart, I look for highs and lows of peak 3 in green, and I try and find that up above in the price, and I draw dots up there, and I try and connect those lines. Same thing with the 10, same thing with the 30. And you know what? The times I don't get channels, that becomes optional time to trade. Because I like channels. They're high percentage. You know, when I can get a steep channel and it gives me 150 pips where you can trade it and get 60, I'm almost 3 to 1. So you could be taking 3 times as many trades and we're making the same amount of pips. Well, what's that reduced to chart time? What's that reduced to stress time when you're in that trade trying to figure out if your stop loss is going to take it out or you're going to stay in it? And I'm just sitting there and I enter the trade. Hey, I'm going to run it to convergence. If it goes, it goes. If it stops me out because it breaks the trend, hey, it stops me out. But in the ones that go, you know, I'm making 3 times as many pips as you are because I could stack trades. So being selective has its rewards. High pips, better head game, less stress in the trade. And because it's such high percentage, you have a not an egotistical attitude, but you just have a confidence. And then you get more and more selective because you find stuff that is so guaranteed to happen. You see a pattern, you know exactly what's going to happen afterwards. So now you know how to treat that pattern, how to exploit that pattern. And that's why I say at this point, I just, you know, I don't take a trade unless I'm going to win it. The only trades I take are the ones I'm going to win. Why do anything else? All right, so in summary, don't just come to tab 29 to try and take a trade. It can serve many masters, and each one of those masters demands a different money management. That's the punchline. Thank you. Hope you have a great day.